that one too had a big run-up in the recent past. That's the State Bank of India management.
Oh, absolutely. And the market really wants to hear from them because there was a miss. Remember, there's a miss on several counts. One, we have to figure out this, cost of funds trajectory, this margin disappointment that's come in, whether it's a one-off or if it's a sign of things to come, because the compression margins is a lot more than what most brokers were penciling in. And then slippages have gone up. Slippages quarter on quarter have doubled for State Bank of India. From around 3,500 odd crores, that number is now above 7,800 crores. So again, there is a seasonality aspect, particularly in the agricultural book, most of the time, most often at this time of the year. But we need to see if there's anything more beyond that agri-book seasonality. So that's, again, a piece of commentary that the market will watch out for. Margins, what's happening with slippages, and in general, cost of funds and loan growth. Loan growth was not bad for SBI, but some of the brokers were looking at numbers of 16% plus year on year. The bank has delivered just northwards of 14%, I think 14.5% loan growth year on year. So we'll see. But it's become a bit of an excuse for the stock to sell off. Nigel, what do you have your eye on?
Well, it was looking pretty okay, but, the bulls would have wanted SBI to be the swing factor on the upside. Unfortunately, it's actually the swing factor on the downside today because things were looking good. All right, I think we are getting, the SBI presser that's going to be starting. So let's cut across and hear out what the management has to say. The chairman, Dinesh Khara, is addressing the press.
They revised the global forecast to 3% from 2.8%. This actually indicates improving prospects across both advanced and emerging economies. Immediate concern about the financial stability seems to be subsiding owing to the resolution of the US debt ceiling standoff and strong action by the authorities to contain the turbulence in the US and Swiss banking. However, the recent downgrade of the US by Fitch over various concerns of the country's finance and debt burden could trigger the bouts of financial volatility with the risk of reactions from the market. Against this backdrop, I would say that Indian economy continues to exhibit stronger than expected growth momentum, with robust domestic investment providing the necessary support amidst weaker external sector dynamics. Looking ahead, real GDP growth is expected to be in the range of 6.5%, aided by the government's thrust on infrastructure spending, traction in domestic demand, revival in corporate investment, and healthy bank credit. Headwinds from prolonged geopolitical tensions and slowing external demand are the key risks to the outlook. On the banking front, credit growth has continued to grow in double digit and became broad-based across sectors. During Q1 of this financial year, all scheduled commercial banks' credit has grown by 16.2% and aggregate deposit has grown by around 12 to 13%. As demand for credit continues, we expect credit and deposit may grow up by 14 to 15% in financial year 24. In the backdrop of this economic environment, I would like to place before all of you the highlights of the bank's performance in Q1 of financial year 24. I am pleased to announce that for once again we have recorded the highest ever profit, and also this is something which is a matter of pride for us. It may not be out of place to mention that very often there is a tendency on the part of the analyst community to really evaluate the performance in terms of quarter on quarter. We have to be very mindful of the fact that the Q1 is always a unique quarter because of the two reasons. Invariably in the last quarter we have sufficient earnings. Various one-offs are there which are getting recorded, whereas in the first quarter those benefits are not available. Secondly, when it comes to asset quality as well, when we reckon the stress or NPA or SMA, they are at a point of time. Whereas the fact of the matter is that at a point of time there could be a deterioration, but overall the recovery keeps on happening every day. For instance, in the current instance also, when we look at our SMA 1 and SMA 2, which is actually stress is somewhere around 7,000 odd crores. But if we look at it at the end of the month of July, we have already recovered 1,500 crores out of that. So I think to that extent, it is very material that we should actually evaluate YOY performance in the first quarter as compared to the first quarter of the previous financial year. So in that context, we have posted the highest ever quarterly profit of 16,884 crores. Net profit for this quarter one has increased by 178% YOY. With operating profit at 25,297, it has increased by 98.37% on a YOY basis. ROA of the bank for quarter one has improved by 74 basis points and it is at 1.22%. ROE has improved to 24.42%. Most other core profitability metrics have also improved sequentially as well as on a YOY basis. Net interest income for quarter one increased by 24.71% on the back of improvement in yields and continuing credit offtake. Domestic NIM stands at 3.47% and it becomes all the more relevant in the context of our bank because our international book is just about 5 lakh crore, 5 trillion, and our total asset side is about 33 trillion. And also when it comes to international book, we are very, very mindful in terms of the evolving global economy and the kind of stresses and strains which are evident in the global economy. So that's the very reason why our domestic book has grown almost at about 15% plus, whereas the international book has grown little lower, and that is a very, very conscious effort on our part. When it comes to operating expenses, they have increased by 23.68%. We have actually started building provision for the wage revision, and we have started building provision from the month of November onwards of the previous financial year, and that is the reason why it looks little on the higher side. But if you really look at it, the cost to income ratio, we are just about 50%. On the business front, the credit growth has been robust across all the segments. Domestic advances, as I was indicating, it has grown by 15%, comprising it's a very broad-based growth which we have witnessed. Retail advances have grown at 16% plus, and corporate segment grew almost at about 12% plus. SME and agri segment have posted handsome growth of 18% plus and 14% plus, almost 15%. Domestic deposits grew almost about 12%, driven by the growth in the current account and the term deposit. This is a general phenomena which we normally witness. When the inflation is on the high side, normally the money moves from the savings bank account to the term deposit, and the same behavior we have seen. And the current account growth is essentially attributed to the fact that we have started focusing on the non-government current accounts, and happy to share with all of you that even in the month of March as well as in the month of June and even in the month of July, we have been growing at a decent pace. It is much higher than any of the competitor also. So which very clearly means that going forward it will have an impact on the composition of CASA in the days to come. With regard to asset quality, our gross NPA ratio has come down by 115 basis points YOY, and it stands at 2.76% and continues to be at its lowest level in more than 10 years. Our net NPA ratio has also declined by 29 basis points and stands at 0.71%. Slippage ratio has improved by 44 basis points YOY and it stands at 0.94%. Consistently improving asset quality is also reflected in our credit cost, which stands at 32 basis points and has improved by 29 basis points YOY basis. We have a well-provided stress book. PCR is showing an improvement by 23 basis points. It is at 74.82%. It actually went up by 127 basis points on a YOY basis and stands at, if at all we include OCA, it stands at 91.41%. On the restructuring front, our total exposure under COVID Resolution Plan 1 and 2 now stands at 22,000 crores, 22,666 crores, as at the end of Q1 of financial year 24. The restructuring book has actually behaved very well. Even if we reckon the SMA 1 and SMA 2 in the restructuring book, it stands at only at 11%, whereas if you recall, we have already kept a provision of 30% for this book. And going forward, we are hoping that it will even behave even better. SMA 1 and SMA 2 does not necessarily become the NPA. This is nothing but a reflection of some kind of a stress on the cash flow for this kind of a book, but we have invariably seen that a significant portion of SMA 1 and SMA 2 gets recovered and it becomes a performing. The broad trend which I indicated, that out of 7,200 odd crores, 1,500 crores we have already recovered within a month of the account turning the stress account. So that's the kind of a situation. When it comes to the capital adequacy, the bank remains very well capitalized and we have sufficient headroom to take care of the normal business growth requirement. We have worked out that based upon the current capital adequacy, we are very well placed to support the further loan book growth to the extent of 7 trillion. Digital continues to be an important customer acquisition engine for the bank across the asset as well as the liability product. During the quarter, we have sourced 63% of savings bank account and 35% of retail asset accounts digitally through YONO. We have recently launched YONO for every Indian, in which customers of other bank can now access experience of seamless UPI journey on YONO. Our subsidiaries have consistently performed well and continue to create significant value for all the stakeholders and most importantly for the customers of the bank. Most of our subsidiaries are leaders in their respective segment and we will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. Before I conclude, I thank you all for your continuous support to the bank. We consider it as a privilege to be able to contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable return over the long term. I wish everyone the very best. The floor is now open for all your questions. Thank you.
Louder. Session, we will move from left to right, allowing everyone an equal chance to ask a question. You may raise your hand and ask a question using the name and the media house you are representing. We request you to please follow the format and restrict yourself to 2 questions focused on the bank's business. If time permits, we may request the circuit for additional questions. Last option? Yes.
Can somebody use the mic, please? I mean, you people can use the mic.
Left to right, you said, na? Lalit?
His left.
That's right.
His left.
Who's left?
His left.
You mentioned.
Anyhow, please go ahead. I think you have seen perhaps it has been a trend in the banking industry. All other banks have also witnessed, and as far as we are concerned, the drop in CASA for us is much lower as compared to what the competition has seen. Not as of now. Sorry? It is 3.47% domestic NIM. I hope so. Because if you look at e-loan advances and our cost of deposit, I think it should be stabilizing around this level. Sorry? I'm unable to hear you, please. Recoveries we have affected recovery of about 1,200 odd crores, whereas last year around the same quarter this was 500 crores more. And the reason behind is at that point of time we had some reasonably higher value of recoveries. Now the stock left out is not all that big in number, and that is the reason why what recoveries are being affected. It may not really look as high as we have seen in the previous years because the chunky numbers are not there now. Sorry? credit card book. No, credit card is a separate entity. It is not in the main bank. But as far as the credit card is concerned, even there also they have made adequate provisions to take care of any potential delinquencies. So I think there is not much of a challenge there. In terms of, so long as the book is well protected, it takes care of the requirements of that industry. See, when it comes to asset quality, I would like to mention a couple of things. One is the underwriting, which I think we have strengthened our underwriting mechanism quite well. Second comes more so when it comes to retail. The very important component for retail is underwriting is very important. It should be essentially loan management system which should be underwriting, which means that hardly any discussion on the ground, so that people should not deviate from the underwriting principles. The second component, which is very important for the retail in particular, is essentially in terms of the control and follow-up. And we have very robust control and follow-up mechanism, and that is the reason why I could immediately relate with you and say that out of 7,200 odd crores worth of slippages, we could pull back about 1,500 crore. So that is nothing but the effective machinery on ground to make the recoveries. So I think we are seeing very good results. So I would say that on these two counts we don't have any challenge. Now when it comes to when you look at slippages, in our case the slippages are not as much coming from the running accounts, and even for that matter, even stock of our stress portfolio has also come down significantly. Corporate does not have anything, SME does not have anything, retail does not have anything. Only slippage has come from SME and agri, and there also we could pull back a significant portion. So I think it's a function of the economy on ground, and I would say that the cash flow disruptions lead to some kind of a disruption in the repayment timing. But more or less, I would say that there is, in terms of quality, it's a much better quality, and in terms of the portfolio.
First thing, sir, I would like to ask about the credit growth guidance which you have given about 14 to 15%. You have already grown 13%. What gives you confidence?
Actually, 14 to 15%, I would say that though it is looking at 13.90, but for all purposes, it is actually 15% plus. Reason behind is that our international book, we will be very selective. We may not grow as we will be growing in the domestic market, for the simple reason that the international markets are very, very choppy, and we will be really growing in those markets if at all we can take care of the quality of the risk. Yeah,
so
please.
Any sector specific, if you can give idea where you are seeing the growth, and also the distribution between corporate and retail?
I think more or less now, as the situation stands, we are somewhere around 60% as far as retail is concerned. So we will be evaluating the opportunities. If at all there are opportunities for growth in corporate, we'll be more than happy to support it. We don't have a constraint in terms of the funds. We have got enough funds available. Even today also we have got excess SLR to the extent of about 4 trillion. So if at all opportunities are there and it meets our risk appetite, we'll be more than happy to support.
So one question regarding NIM, that has been one of the points which has been raised by the analysts, although you have mentioned that one should not look on quarter. But what has been the reason behind the decline?
See, reason is, if at all, I would, last quarter of the previous year, we had about 850 odd crore worth of interest coming on the income tax refund. So these one-offs are the one which are normally seen in the last quarters. So in fact, in this quarter, we don't have any one-off.
Okay, well, that's the SBI chairman, and we'll go back to it as more clarity and more comments about the future come through. 2.6% lower, stocks at about 575. We'll take our first commercial break here. Prakash Diwan will be with us, and so will Mithun Aswath on the other side. Stay tuned. Those gentlemen join us in just a bit.